This video is for educational purposes only and is not professional financial advice. Do your own research before investing. Rocket Lab USA, ticker RKLB, is one of the most talked about names in the new space economy, and for good reason. Revenue is growing at 63% year over year. The company is launching rockets, building satellites, and expanding its footprint across the entire space supply chain. But the real question isn't whether Rocket Lab is impressive. It's whether it's actually capturing a market large enough to justify where this stock is trading today. Over the next few minutes, this analysis covers everything that matters: the scale of the market opportunity, the raw velocity of the growth story, the structural durability of the business model, what the unit economics reveal about profitability progress, and whether the current valuation makes sense given the growth on offer. The numbers tell a story, and it's not a simple one. Stay with it. The aerospace and defense industry is undergoing a generational transformation. Government space budgets are expanding, commercial satellite constellations are proliferating, and the demand for reliable, cost-efficient access to orbit has never been higher. Rocket Lab sits at the intersection of every one of those tailwinds, offering not just launch services, but spacecraft manufacturing and on-orbit management that compound its addressable reach. The revenue trajectory makes that positioning tangible. 4 consecutive quarters, $144.5 million, $155 million, $179.65 million, and now $200.35 million, show a business that is not just growing, but accelerating its pace of market capture with each passing quarter. The stock currently trades at $101.65, sitting in the middle of its 52-week range between $33.73 and $151. That positioning suggests the market is neither euphoric nor dismissive. It's watching and reassessing. With approximately 2,100 employees generating roughly $286,570 in revenue per person, Rocket Lab is beginning to show real operational leverage. The question is whether that efficiency compounds as Neutron development matures and launch cadence scales. The flywheel is spinning faster. That is the single most important thing the growth data communicates, and it deserves a moment to land. Revenue growth at Rocket Lab isn't plateauing, it's accelerating. The year-over-year rate just hit 63.5%, up from 35.7% the prior quarter and 36% the quarter before that. This is not the pattern of a maturing business coasting on past wins. This is compounding velocity. Trace the arc. Back in the first quarter of 2023, revenue was $54.9 million, growing at 34.9% year-over-year. By the second quarter of 2024, that figure had climbed to $106.25 million, up 71.2%. Then came the breakout. Fourth quarter 2024 delivered $132.39 million, up a staggering 120.7%. And the most recent quarter, first quarter 2026, reached $200.35 million, 63.5% above the same period a year ago. The trend line here is unambiguous. Demand is absorbing Rocket Lab's expanding capacity faster than the business is supplying it. Each new launch, each spacecraft contract, each component sale appears to be pulling the next one forward. The momentum is real. The question is whether it can be sustained at this altitude. Without a clear peer set to benchmark against, the most honest way to assess Rocket Lab's competitive durability is to let its own internal metrics speak. The financial health scorecard tells a nuanced story. Start with gross margin, 34.4%, and critically, it is expanding, up 37.5 percentage points over 5 years. A business that began with negative margins and has systematically built pricing power and manufacturing efficiency is demonstrating genuine structural improvement. That kind of trajectory doesn't happen by accident. It reflects a business model gaining leverage. Revenue growth year over year sits at 63.5%, a figure that signals Rocket Lab is not just holding ground, it's taking it. But the Rule of 40 score of -16 is a sobering counterpoint. The benchmark for a healthy growth stage software or technology business is 40. Rocket Lab is well below that, reflecting the reality that free cash flow is still negative. The business is burning cash to fund its expansion. The revenue momentum chart over the last 8 quarters reinforces the directional story. The bars are climbing and the year-over-year labels are trending upward. Demand is durable and appears to be strengthening. The verdict on competitive durability. Rocket Lab's moat is real but still being built. The expanding gross margin is the clearest evidence that the business model has structural integrity. The cash burn and Rule of 40 score are the clearest reminders that the moat is not yet fully fortified. The gross margin progression at Rocket Lab is one of the most important signals in the entire dataset. Starting at -3% in 2021, the company has expanded margins to 9% in 2022, 21% in 2023, 26.6% in 2024, and 34.4% in 2025. That is a 37.5 percentage point improvement in 4 years. A trajectory that reflects a business learning how to scale manufacturing, reduce per-unit costs, and capture more value from each contract. The Rule of 40 score sits at -15.5. The 40-point benchmark combines revenue growth rate and free cash flow margin. Rocket Lab's strong growth is being offset by significant cash consumption. With a burn rate of approximately $26.82 million per month and a cash runway of roughly 17 quarters, the company has time, but not unlimited time, to close that gap. The revenue per employee figure of approximately $286,570 across 2,100 employees signals that headcount is being deployed productively. The question is whether revenue continues to scale faster than the workforce. That brings a natural bridge to valuation. The current price-to-sales ratio stands at 61.5 times, matching the sector median. The enterprise value-to-revenue ratio is -234.4 times, reflecting the complexity of the balance sheet at this stage. Is the market paying a sector-appropriate multiple for the growth and margin improvement this company is delivering? That is precisely what the next scene examines. The price-to-sales history for Rocket Lab is a study in sentiment extremes. In late 2021, the multiple reached 89.2 times, pure speculation territory for a company with minimal revenue. By the end of 2022, it had collapsed to 8.3 times, then climbed back to 10.9 in 2023, 29 in 2024, and 61.5 times today, exactly at the sector median dashed line visible on screen. The market has recalibrated from irrational exuberance to something more grounded, and the current multiple reflects genuine respect for the growth Rocket Lab is delivering. The valuation meter shows a price-to-sales-to-growth ratio of 0.97 times. In plain English, the market is paying less than $1 of multiple for every 1 percentage point of annual revenue growth. A ratio below 1 is generally considered favorable. It means the growth rate is not fully priced in. At 0.97, Rocket Lab is sitting just inside that threshold. The revenue growth trend chart reinforces why. Year-over-year growth is accelerating, not softening. That acceleration is the variable that justifies a premium multiple. The gross margin trend bars, from -3% to 34.4%, demonstrate that profitability is structurally improving, which supports a higher multiple over time. The Rule of 40 score of -16 is the primary challenge to that argument. Until free cash flow turns positive, the full premium case is incomplete. The analyst scenarios are instructive. The base case of $983.68 million in forward revenue implies a forward price to sales of 59.8 times at the current market cap. The bull case assumes multiple expansion to 73.8 times on stronger execution. The bear case compresses to 43.1 times if growth decelerates or rates tighten. 4 risks and 4 catalysts frame the shareholder decision here. On the risk side, first, cash burn is the most immediate structural concern. At $26.82 million consumed per month and approximately 17 quarters of runway, Rocket Lab has time. But the clock is visible. A capital raise or dilutive equity issuance could weigh on existing shareholders if the path to free cash flow positivity takes longer than expected. Second, multiple compression is a persistent threat for any stock valued at 61.5 times sales. A shift in interest rate expectations or a broader risk-off rotation in growth equities could reprice RKLB sharply, independent of operational performance. Third, competition and disruption remain real. The launch market is attracting well-funded entrants, and any erosion in Rocket Lab's launch cadence advantage or spacecraft win rate could slow revenue growth faster than the current trajectory implies. Fourth, dilution risk. A company funding growth at this scale frequently issues equity or stock-based compensation that gradually reduces per-share value over time. On the catalyst side, first, neutron development milestones. A successful test or commercial contract for the medium-class launch vehicle would be a step-change event for total addressable revenue. Second, sustained gross margin expansion toward and beyond 40% would dramatically improve the Rule of 40 score and unlock a new category of institutional buyers. Third, a path to free cash flow break-even, even a credible forecast, would remove the single largest overhang on the valuation. Fourth, government and defense contract wins, particularly with classified or high-value constellation customers, would validate Rocket Lab's positioning at the premium end of the market. Here is the verdict. Rocket Lab is a growth story with genuine momentum, real structural improvement, and a valuation that, unusually for a high multiple stock, does not yet appear to have fully priced in the growth rate being delivered. The bull case is straightforward. 63.5% revenue growth is accelerating. Gross margins have expanded 37.5 percentage points in 4 years, and the price-to-sales-to-growth ratio of 0.97 times suggests the market is not yet paying a full premium for the pace of execution. If Neutron delivers and margins continue to expand, the re-rating could be substantial. The bear case is equally clear. The company burns $26.82 million per month. The Rule of 40 score is -16. And a 61.5 times price-to-sales multiple leaves little room for execution stumbles without a painful multiple compression. Weighing all of it, the acceleration signal, the margin trajectory, the measured valuation relative to growth, and the identifiable risks. The verdict here is growth buy. The market is pricing Rocket Lab's growth reasonably. The opportunity is real. The execution is trending in the right direction, and the risk is knowable. Do your own due diligence, but the data makes a compelling case for why this name belongs on a serious growth watch list.